Welcome to Retirement Unpacked, a weekly podcast by Parallel Wealth. I'm Adam Bornn, and each week, along with our team of experienced financial planners, we'll explore the ins and outs of retirement, from income strategies to taxes, lifestyle choices, and everything in between. Before we dive in, a quick note. What we share here is for educational purposes only. It's not personal financial advice. Everyone's situation is unique, so be sure to talk to a qualified financial planner before making decisions about your retirement. Let's get started. Welcome to episode 5 of Retirement Unpacked. Again, here with Brett Martinson from the team here at Parallel Wealth. Brett, thanks for joining us today.
No problem.
Yeah. So again, we want to say thank you to everyone that's adopted our podcast, been asking questions, been really enjoyable, and hearing your feedback. We've got great response. And so just as a reminder, if you have questions, comments, whatever for us, make sure to comment those below, whether you're watching on YouTube or listening on Spotify, Apple Podcast, or another platform. So let's jump into it here. Again, we want to go through, we got about 9 questions from viewers we want to get through, because we find that if one viewer has a question, many viewers have the same question. So the first one is benefits of melting down RRSP early with your maxed out TFSA. So the idea here is like, if I have a max TFSA and now I have money in non-registered accounts, does it make sense to actually draw down my RRSP? And I think this really goes back to the concept of making sure you don't have any zero taxable years. So this question was from Garfield Irwin on YouTube. And there's some feedback here as well from other viewers. But really the point is, and there's a comment on here from James Howlett 3921 of, look, the idea here is you don't want zero tax years. If you're sitting on cash because you maxed out your TFSA already, why would you not just live on the cash? And it does create a tax issue. Again, you don't want your average tax rate in retirement to look like a roller coaster.
Yeah. I think there's two things going on here. One is if I am in a very low tax or no tax year, why would I add to that tax by taking money out of my RSP or RIF? And then I think the other part that may or may not be in this question is if I do take money out of my RSP and RIF, which is deferred taxation, so I don't have to be taxed on it until I take it out. Why would I take it out and put it into a non-registered account, assuming my TFSA is maxed, non-registered account, which is taxed yearly on dividends and income and taxed on disposition for capital gains? So tackling the first one first, which I think is the main question here, is as we talked on one of our last episodes, I think it was the last episode 4, where just because you're in a zero tax year does not mean that that is fantastic and don't touch it, don't move it, because we're also looking into the future of, well, what's your future taxes when your CPP and OAS kick in, or even if you're taking your CPP and old age security, when the government is going to require you to start taking money out of the RSP and RIF. And when we get into those later years, you're at a 20% withdrawal from the RSP and RIF. So putting all that into play is, I often say RSPs are kind of like a drug. You avoid taking money out now. It feels good, but it might hit you like a ton of bricks later on down the road. And just looking at James's comment there, I just want to read it again. If you have years with zero or very low income, then withdrawing some on those years will save you a lot of taxes. And yes, I should say it may save you a lot of taxes. That's where a plan comes into place.
Yeah. And the reason for it is because we live and operate in a progressive tax system, meaning that, the first little bit of income is tax free, the first roughly 15,000, and then it's a scale up. So as you make more money, you're paying a higher percentage of tax. So if you have 0 years, you're paying no tax, but then you're lumping those years where you could have paid a little bit of tax or no tax on a certain amount on your marginal tax rate at a higher tax rate down the road. So just remember, when you live in a progressive tax system like we do, you want to level that out as best as possible. So,
Yeah.
and that really goes to like decumulation of assets. And we've had this question a lot, and this jumps into question number 2. This is from David Black 6413, again on YouTube. And this is a longtime viewer of Adam and Parallel content. Really like the series and format. So thank you for that. If it were possible, I'd like to see a Decumulation 101 episode. I appreciate that decumulation is more idiosyncratic and individual than ever. than the accumulation phase, but there must be but there must certainly be some common compass point for those of us, whether our financial situation is simple or complicated in the drawdown years. So yes, there are general rules, and the good news is by the time this podcast comes out, we will have that video on YouTube. So that'll be live on YouTube. We're doing a decumulation 101. But another layer to that's really exciting is once that YouTube video, and we'll link it below as well, we're actually doing kind of a 5-part series behind the scenes, not on YouTube. You can watch it offline here, of decumulation. So if you're a DIY investor, if you're in mutual funds, if you're, you have a professional money manager, there's different kind of styles that you could have. How do you decumulate? So great, I have a great plan, but how do I actually decumulate the assets? Yeah, we put a whole series. So really excited to launch that, and really it's a tool to help everyone out there, no matter what situation, how you're invested, how much money you have, what your drawdown strategy is. The process, yeah, there is a compass to follow. And so we put together a series of videos to help people walk through that.
Yeah, and that's also helpful. We get questions often from clients 3 or 4 years down the road. Something has changed, or hey, my RSPs RRIFs have really gone through the roof in the last few years with my returns. Whatever the change may be, what should I do now? How should I change that type of thing? And not to say that just doing a rule of thumb and foregoing a plan update is the best idea. But again, that comes into play with the decumulation too. Is how do I change when and if things change?
Yeah. And how do I know if my plan is off track? That's another thing that you want to talk to your planner about too, right? So, but yeah, the
Yeah,
decumulation, I think the biggest question we get is, well, what happens if the market drops 30% in year one of retirement?
yeah,
And our philosophy, and what we always tell clients is that shouldn't matter. On paper, sure, some of or a lot of your portfolio has dropped in value, but the idea behind a good decumulation strategy, and again, we'll cover these in the video, so make sure to check those out, is protecting yourself against that. So again, we get a lot of questions about like sequence of returns and Monte Carlo simulation and all that. And that's great. Like you can run those, but those are what if. What if this happens? Or what if this? And it's really pie in the sky. Whereas when you create a good plan and you know exactly how much income and where it comes from, why not protect again that cash wedge, like 3 years of income, like protect it in a proper way. So again, check out those videos. You can kind of learn all about that. And again, those videos, the idea behind that is like, here's video one, but as we get comments and feedback, we're going to create more videos on there to really give all of our viewers and listeners the tools that they need to really walk through retirement with great success.
yeah, absolutely. Quickly, I know we're spending a little bit on this one, but quickly on this, when this comes up with clients, I say, well, look at education funds. Like for example, my kids, one just graduated, the other one is just started third year. So going back a handful of years, 5, 6, 7 years, when they were getting closer to going off to school, I would call the RESP a 4-year retirement plan. Right? They are retiring educationally within about 4 years of starting. And so I would follow the same decumulation phase that when they were 5 years old, that money was invested entirely differently than when they were 15 and 16 and 17. And it follows that decumulation of regardless of what happens with the market, that I want to make sure that money is there and hasn't dropped 30% when they're just about to go off to school. And I don't want to take any more money from my money. I want to use the RESP. My money is my
Exactly, and
money.
that's the extreme example because that's like a 4 to 6 year window typically. RSP typically, or retirement typically a little bit longer on the drawdown, but yeah,
Exactly.
the concept's the same, right? Like
Yeah.
protecting, knowing when you need that money, how much, how that has to come out, and then just protecting it. So a market downturn in retirement shouldn't affect your cash flow, your travel, your hobbies, your whatever you're doing.
Yeah. Yeah, exactly. All right. I think we teased enough those other videos coming out, which, as you said, should be out by the time this one's out. So,
Yeah.
so hopefully all good. So we had a question from a client with one of the planners on the team, Paul on the team. One of the clients asked about how does a reverse mortgage work? What are the pros and cons? On my side, and I'm going to start here with the idea that I think reverse mortgages can get a lot of bad rap, and there are probably very good reasons. I'll say similarly to insurance that it is put into place more based on what the commission or the check the person is doing the job is going to get versus what's the best thing for you. So insurance isn't a terrible thing. It's just what's right, what's wrong. Same thing with a reverse mortgage. So a reverse mortgage in general is borrowing from your house, getting access to the cash in your house, but not necessarily having to pay it off like a traditional mortgage right then and there. So I take a mortgage line of credit, whatever, against my house. I have certain monthly payments, whether it be interest only, just to keep the growth of the loan at bay, or I'm paying down that loan. A reverse mortgage effectively is saying, we won't take payments or large payments from you up front. We'll give you the cash up front, but we are going to be the first people that get to take the value from your home when you pass away or move or whatever the agreement is. So that we are going to get paid back plus interest. It's going to happen. And then whatever's left of the value of the home will go into your estate. That is the nutshell that I describe reverse mortgage. Your thoughts, Adam?
Yeah, and a lot of people may have heard of the term chip mortgage.
Yeah.
That's kind of the reverse mortgage. Again, it's really I have equity in my home, and a lot of people we talk to, especially in BC and Ontario, but right across Canada, house rich, cash poor. It's
Yeah.
yes, I can retire, but the $2 million that I have is all tied up in my property, and I don't need it. So how do I kind of manage this? And there's a few different ways to do it. We talked about it before on the channel, but you got to find something that's comfortable for you. Like understand how it works. Like if you like a chip mortgage is interest on interest, so
Mhm.
it can start compounding itself, which again might be a solution for you. But understand the underlying process and how it works, and make sure that I'm not going to run into trouble. Because if you say, "Well, I'm going to do a reverse mortgage," whatever that looks like for you, if at the end of the day it's like it works, but by 84 I'm going to have to sell the property and I'm in a tough situation, that might not be a good solution for you, right? So again, talk with your financial planner around how can I access some of this? Maybe downsize is a better option for you, and downsize before you get too old where it's very difficult, right? So I have all my equity in here. Yeah, I could do a reverse mortgage, but I don't know if that's going to be the best. Why not downsize, take some of that equity, and invest it conservatively, obviously, but actually have that money working for you. So you're not paying interest on interest. You're actually having your money work for you. That might be a better solution. So again, a little bit different for everyone, but yeah, reverse mortgage is essentially, however you want to cut it, is you have equity in your home that you need to live and enjoy retirement. How do you access that?
Yeah, yeah. And the one question I tell people to ask whenever they're in these kind of situations, we're talking about a reverse mortgage, we're talking about insurance, we're talking about investments, whatever. Say the best question you can ask is, what's the downside to this? What happens if things don't go as planned? Because nobody complains about the upside, right?
Yeah.
Uh, I expect to make 5% of my investments and I make 15. I'm not complaining. But what I do want to know is, okay, what's the downside? Well, this investment could go down negative 15, could go down negative 25, could go away, completely. You could lose all your money or whatever those parameters are. Same thing with insurance, same thing with the reverse mortgage. Is that, I think, is the most important question you can ask when you are considering something that you're not too sure about, is to understand, give me the downside. Talk to me about
Yeah.
the worst possible scenario here, because I'm not going to complain about the best possible scenario.
And that's often the case. I had a client about 15 years ago. Her mom had a reverse mortgage. It was through the CHIP program, but I think that's beside the point. They had
Mhm.
a reverse. She had a reverse mortgage, and that wasn't explained to her, right? It's like, hey, yeah, we can get you all this money. And it's going to be great, and you can enjoy retirement. It was age 81 that the thing blew up on her.
Yeah.
And so it wasn't a great solution because the downside wasn't talked about. My client had to kind of step in. They had to sell. It just an absolute mess. So again, no matter how you do it, look at the downside. Brett brings up a great point there. It's look at the downside. The upside is you got this equity. That's the obvious. What
Yeah.
is the downside? So
Yeah.
jumping into the next question here. So this came from Jim Sterney on YouTube as a comment. For a retired couple who had no kids, what's the most expedient and tax efficient way to transfer the home to a recipient, likely family, prior to death?
Yeah. Hey, people must be listening to us because a lot of these names are actual names as opposed to JS 12385,
Exactly.
Alpha Centauri.
Exactly.
Yeah. So the most tax efficient way to transfer a home to a recipient. So assuming that the principal residence exemption applies here, let's just say it's your only residence, Canadian resident, obviously only resident, then there won't be any capital gains under the current rules. So we can put that aside. So what's the next challenge that might come along is that you pass away, your house and other things go into your estate, and then there's a state administrative tax or probate or something like that. So with that said, the most expedient and tax efficient way to transfer it to something that isn't a registered charity, for example, we're talking about likely family here,
Mhm.
is quite frankly, one option is to sell it if and when you don't feel you need it anymore. And we're probably talking about selling and going into a rental versus another property or smaller value property, and then give that money away, because any money that we give away prior to death or certain ways set up in wills, but we'll put that aside. Any money we give away prior to death does not go into the estate. It's not there to begin with. Doesn't go through probate and such like that. I will touch on two other things quickly here. One thing I see is they'll put family or other people joint with the property, and as Jason Pereira often says, joint accounts should come with a warning label, and I agree
Mhm.
in that. God forbid that person that's joint on that house runs into some financial problems. They're sued because of something happened at work, or their relationship breaks down. That's part of their assets that could potentially get involved in that issue. So now all of a sudden, some or all of the value of your house is going somewhere that you didn't expect it to. The final thing I'll mention here, and then Adam, I'll try to give you a word in edgewise, is on average across Canada, probate is about 1.5% of the estate. It changes for province, territory, but let's just use 1.5. So if the only thing that goes into a state is $1 million house, or if your total estate is $1 million, non-registered, house, whatever, we're talking about $15,000. Now it's still $15,000. I get that, but I don't think it's the number people think it is, because typically the big number that we think of as estate tax is actually the tax on RSPs and RRIFs and locked-in accounts. So there's my thoughts on it. Sell it is one option. Joint, I would caution highly against. And the fact that maybe the taxation and the probate is not necessarily as much as you think it's going to be.
I think I have this. I feel like I have this conversation every week with somebody. It's like, oh well, we want to add one of our kids to our home or something. It's like,
Yeah,
yeah, you're complicated. And I think a lot of people are trying to simplify things, and then they make a decision that really complicates it, right?
yeah,
And so even selling the home, it's like, yeah, that does simplify it in a way, but now you're renting like in your 70s, 80s, 90s, like that's not simple. Wouldn't you rather just pay 15,000 in probate? The most simple way in my opinion, would be again, yeah, stay away from joint. A lot of issues there. If you do that, make sure you talk to a lawyer that knows what they're doing and structuring it properly, etc. But yeah, just hold on to the property. Have a good updated will that states when I pass away, the house is sold and it's passed on, or maybe the house is passed on as is to a beneficiary, family member, whoever it is. So I think a lot of the times, and the point I want to make here is a lot of times we want to simplify stuff, but by triggering an action, we're actually complicating the process. So
yeah,
you right is it goes back to the whole KISS model, like keep it simple, stupid, right?
yeah,
And that's what we need to do most of the time. It's like, oh, I need to create this and a trust and this and this. It's like, okay, you've overcomplicated. You're actually costing way more than it would have been had you just left it through your estate, and the will would have stated who gets the house or money or whatever you have left at the end of the day.
yeah. And I think this also points to another overarching strategy or consideration is that whenever you're thinking about something like this, have somebody do the math. Because if somebody came to you and said, "Well, if you leave it the way it is, it's ultimately going to cost your state $10,000," you may say, "Well, that's not worth it to me." Some people, that $10,000 they'll fight tooth and nail for. Fantastic. Other people will say that is the price of me staying in this house as long as I want to, and the rest goes off to church, charity, family, friends, that kind of stuff. So figure out the
Exactly.
cost of it, and then figure out whether or not it's something to
Yeah.
look into further. Yeah,
And depending where you live, obviously, often the cost isn't that much at the end of the day. So,
exactly.
yeah,
Yeah, yeah.
yeah.
So Oh gosh, the authentic Pablor? Oh my gosh, now
I'd
we're
go with
back into
that.
these.
Yeah.
Yeah,
Yeah.
these
There you
crazy
go.
names. Yeah. I have a question for a future episode. Again, thanks for making the comment. That's what this is all about. How to manage withdrawals when you have a big portion of your savings on non-registered, or I believe in non-registered accounts. So it gives a quick example: a million in RSP, a million in non-registered account. I've already decided I want this problem. $175,000 in TFSAs, retiring at 65. CPP, old age security. We can get into all the other details here, but the general question I believe we're going for here is that you've got $1 million in non-registered, $1 million in RSPs, and let's just say your TFSAs are maxed out.
Mhm.
All right, Adam.
Yep.
Other than being adopted by this person, what's our solution?
Yeah, no, I think this comes. I always say, like, the RSP meltdown is for 99%. It works for
Yeah.
99% of people. There's a 1%, and I can think of two clients that we've had through our door over the last few years where the RSP meltdown didn't work. One was kind of a one way or the other, it didn't really matter. One was it actually didn't make sense for them.
Yeah.
Um, and that typically comes when you have a large RSP and a large non-registered. That's
Mhm.
typically the trigger point. Uh, Looking at these numbers, I think an RSP meltdown would make sense. But the point he makes later in his comment here is, the problem is that 6% is average return, so it can go north of that.
Yep.
So if a year the market is good, let's say 10%, you can gain $100,000 that may bring 50 of taxable income in the non-reg. So is it still worth taking money out of the RSP? And this is going to be where you need some flexibility in your plan. So yeah, when you build a plan, obviously, okay, well, if we assume a 6% rate of return on your non-registered account and you have 15 or 20 or a big gain in there, yeah, that could mean you have to draw a little bit less out of your RIF account. That's where you need that flexibility. So you need strategy going forward, but you need the flexibility to flex when you have that non-registered account. One of the first questions I would ask Mr. Pablo here would be, at the end of the day, are you using that $1 million of non-reg? Like, as we build a plan out and look for how much cash flow you need, in situations like this that we see a lot of the time, Brett, it's, yeah, I know, your estate's worth a million or multiple millions by the time it compounds over time and you die. So yeah, well, I plan to leave that to my kids. Okay, perfect. Well, that non-registered account is actually creating a bit of a tax issue for you, right? It's money you never need. We've proven that. It's going to your kids in 30 years from now. Could we help the kids out now? Maybe not give all of it to them, but could we help them? Again, maybe this is climb back your old age security. I mean, if you have a 10% rate of return, you might be losing OAS or some of your OAS now. So there's a lot of tax movement here. So the first question would be, let's figure out if you need all this. And if you don't, what is the game plan? If the game plan is to leave the money to kids, are you open to maybe passing some earlier? Like, maybe we can help pay down their mortgage. They're paying 5, 6, 7% on their mortgage. Could we
Mhm.
reduce that for them?
Yeah. Absolutely, and a couple things. First of all, mentioning that say you make 10%, you can gain $100,000. Well, that is assuming the 10%. So they say you can gain 100,000 that may bring 50,000 of taxable income. So what we're talking about here is that 100% of your investments in that year were capital stocks, equities,
Mhm.
those types of things, and that you disposed of them in that year or were deemed to have disposed of them of
Exactly.
them. So first, there's some things that can be uh, potentially massaged in terms of what is the best investments to hold in that non-registered account based on what your goals are and things like that. So that's one aspect to be talking to your advisor or financial planner about. And then the other one is you're talking about is if you don't feel you're going to need this money, and depending on your comfort level of starting to give it away, again, church, charity, family, friends, then it could either be either a gift to, let's just talk family here for a moment. It could be a gift to family. Now they legally own it. They can do whatever they want. God forbid a relationship breakdown. There's issues there. You can loan it to family, which tends to protect it, not always, but can protect it from a relationship breakdown. There, you could potentially put it into an insurance product, and there now you're getting some tax deferred growth. You could again loan it to family or a spouse who has a lower income. This is a great point about financial planning. There is no one best way because first and foremost, you're different. You have different goals than your neighbor with the exact same net assets. So it's more of a conversation of what are we doing with this money? Are you spending $300,000 a year or $30,000 a year? How much of this money do you need versus don't need? And then providing the options to say, well, here's the pros and cons of loaning it, gifting it, insurance policy, and then we make whatever decision makes them sleep at night.
Yeah. And based on how
Yeah.
many cars my neighbor has, I think our net assets are a little bit different. Yeah. Just going to throw that out there.
Yeah, I still want to know that the authentic Pablo is considering adopting people because just reach out to me if you're considering adopting.
Exactly right.
Yeah,
Yeah.
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 Next one there.
Uh, yeah. You want to go through that there? My
Yes.
computer just shut down on me here. So I'll let
Oh,
you
no
jump into the
problem.
question. Yeah. Yeah.
I will hold off on comments about different computers and operating systems.
Yeah, I'm a Windows guy, Brett's a Mac guy. We won't get into it. That's not what this podcast is about. But yeah, yeah. But large market swings.
uh, yeah, future. So this is from ST Moore. Future podcasts could include adjustments when swings in the market are outside of 10% plus or minus in the financial plan. So um, I part of this I think is your favorite question around Monte Carlo and uh, market volatility. But I can start with it if you need a bit
Mhm.
of time with your
No,
computer
I
there.
got back in. Yeah, no.
Oh, oh,
Windows, you can actually get in and out really quick, so it's good.
oh, okay. All right. As
Yeah,
long as they
just
have one
FYI.
good redeeming quality.
Exactly.
Yeah. So when the market swings are outside of 10 plus or minus percent of the
Mhm,
financial plan, um, this is one thing that we actually mention to our clients a lot. It's in the deliverables that we send. We use 15%. But the idea there is that as the actuality of your accounts are starting to diverge from the projection in the plan, and they will, because
mhm.
it just never be perfectly on base, is at around that 15-ish% or 10, if that's your comfort zone, that you might want to be looking at either an update of the plan or there might be a need to speed up RSP meltdown, slow down RSP meltdown. It all falls into that area of if there's a major change, whether it's markets, whether it's inheritance, whether somebody got married, divorced, whatever the case may be. If there's a major change, then yeah, you're probably going to want to revisit the strategy. But in general, what I would say is that the more the markets go up over a period of time, over a trend, not 6 months, not 12 months, then we may need to be speeding up an RSP meltdown if there's still RSP riff.
Yeah.
Adam, your thoughts?
Yeah, well, I had a conversation with a client the other day, and he said, "Well, Adam, in good years, if we get 15% rate of return, then I want to carve out some of that gain. Like anything above the planned state, I want to carve it out. So if we say, well, let's build it at 5%, so 10% of the gain I have that year, I want to actually carve out. That's that bonus." And I said, "Well, wait, like that sounds great, but we don't have a consistent. It doesn't mean every other year we're going to get 5% or above either. Like
Yep.
we're going to have negative years, and the really good years typically offset some of the bad years.
Mhm.
Hopefully, we average more than what we projected at 5%, but don't just carve out the gains.
Yep.
Um, that can be very dangerous. So that's one thing of like, okay, well, I had a big gain. Accounts are worth a lot more. Let's take more income. Well, okay, over a 3 or 5 year period, if the gains have been more, and okay, we're our water level's a little bit higher now. Yeah,
Yep.
then maybe we spend a little bit more, take a big chunk out or whatever. But uh, don't get into that process on a year to year basis.
Yeah,
Yeah.
exactly. I had a similar question from a client. I think it was in the last week, could have been this week. Let's say you've had a 20% run in your RSP riff. Then if you are going to carve out those gains, I would don't speed up the tax plan. Don't take that out of your RSP and RIF unless you got really good reasons to do so. But if you want to move that 10 or 20% down into bonds, GICs, cash, if you want to say, look, I'm going to guarantee this money is here no matter what the rest of the money does. This is an investment advisor conversation. If you're do it yourself, then you're taking this responsibility on yourself, but you could consider that. But the keyword there is consider. Know all your options before you just start making changes just because one year it was 10%, another year it was -5, another year it was 25.
Yeah,
Yeah.
and well, that's the thing, right? Like, okay, I got a 15% rate of return, so I'm going to carve out the top 10% above what my plan shows. But then those
Yes.
same people will have the mentality of, I got 0% or minus 5% rate of return. So I gotta scale back on my income.
Yeah.
It's
Yeah.
like, no, we're trying to avoid this roller coaster. So yeah,
Exactly.
don't ride the roller coaster. That's for Disneyland, not for your financial plan. So question number 7 is around donations. My computer crashed again, Brett, but I
Okay.
don't need to see it here because we've had a lot of comments on donations, and I want to dig into this a little bit. So people always say, like, come retirement, like, or I'll say pre-retirement, there's a couple ways to reduce your tax bill. You can make a contribution to your RRSP, or you can make a donation. And making a donation can create a nice tax credit. That tax credit can be used that year or any 7 years going forward. So it is flexible that way. Um, Now, in retirement, again, if part of your plan has, charity or some sort of donation in your plan, then yeah, you want that mapped into your plan because that can be a big tax benefit. Now, again, the tax credit province to province is a little different, but for simplicity, let's just call it 50%. So if you're making a $10,000 donation, you're getting a $5,000 tax credit, meaning that if you owed 5,000 in tax, you now owe zero. So making donations in retirement can be a huge benefit. Now, we can donate cash. So you can sell something, take the cash and donate it. Or better yet, and this is a really key point, I've done a few videos on this. If you're someone sitting there with non-registered investments
Mhm.
and have some gains on there, so I have a non-registered account, it's worth $100,000, and one of the investments I have in there has done very well, and it's gone up quite a bit, and I have a $10,000 gain on that investment. And so it's worth 20,000. I only put in 10. I have a $10,000 gain on there. If I wanted to make a $20,000 donation, I could sell that stock because it's done well. I want to trigger it, sell it off. But I have a $10,000 gain, meaning 5,000 of it's going to be taxable. I'm going to owe a few $1,000s in tax. I'm only going to have $17,000, $18,000 left in my pocket to actually donate out. Alternatively, we can actually donate that stock in kind to the charity. So you donate the actual stock. You don't sell it. You actually donate the stock. The charity gets $20,000. They sell it on there, and you don't have to deal with that. And you get the full $20,000 donation credit. And guess what? CRA never collects that capital gain tax. That is never triggered. So it's one of the few areas where there's actually a double tax benefit in that you avoid the capital gain tax and the charity, well, triple, and the charity gets the money and you get the donation receipt. So again, that's a tool. My wife and I do that. We have an unregistered account. We use a program called GiveWise, and I'll give a shout out to GiveWise here. We don't get paid by them. They're just they're a platform where you can actually donate into and then donate to all the charities from there. So if you're someone that donates to multiple charities throughout the year, you're looking for all those different donation receipts. With GiveWise, we put money into GiveWise, and then we can give it out from there. GiveWise gives us our donation credit. It's also a way if you have a really high tax year, maybe it's in the last year you're working, you want to make a big donation to reduce taxes, but you don't want to give all that money out today. You want to give it out over time. That's a great strategy to do as well. But yeah, when we talk about donation, I'll let you talk here, Brad. No, I'm rambling on, but
Right on.
I'm a big proponent. It's I think people say, well, why should we give money? And that's a whole nother conversation. I won't go down that rabbit hole here on this podcast. But if you have a heart to give and help those organizations in your community or broader, whatever your passion in your heart lies, at the end of the day, making a donation, again, it feels good. You're helping out people or organizations that can use that money. And again, a lot of these organizations that run, like I think in my community here, like people that feed school kids, what
Mhm.
lunch programs and Salvation Armies, and there's a multitude of organizations that are in my community here in Langley that make a big difference. And without those organizations, well, guess what? Those types of people are now leaning on the government, and there's more government money going out, meaning we pay higher taxes. So it is a bit of a circle that goes around. But yeah, it can definitely help. And again, you want to build it into your retirement plan. I think that's uber important. The software we use, Snap Projections, there's a donation module in there. We can show you cash donation or stocks in kind. And so it can really change the tax dynamic in retirement. So instead of waiting at the end of life saying, well, whatever's left, I'll just donate away. That's another conversation. Look at donating it ongoing to reduce your ongoing tax bill.
Yeah, exactly. And this is from so the question we've been just touching on here was from your best Fred underscore YEG, which I think we've had questions from your best Fred before. I know very few Fred, so he probably is my best Fred.
Yeah, there you go.
Yeah, he's talking about integrating. I'm just going to touch on the things I think you've touched on. Effectively integrating charitable giving into your retirement planning. If the tax credits earned via donations can be carried forward, yes, up to 7 years, and that he and his wife are considering establishing an endowment fund in the future early days. Though, again, to kind of almost go with the theme that I didn't realize was going to be the theme of this podcast is what's the overarching strategy here is that you sit down with somebody who's knowledgeable in these areas, and a conversation my wife and I always have is let's not prescribe the solution, let's prescribe the goal, meaning that you'd sit down and say, look, I want to be charitable, I want to give money. What are the various ways I could be doing that? Because
Mhm.
you're right, you could give directly to a charity. You could give wise. You could potentially name a beneficiary on your RSP and RRIF. There's so by somebody sitting down and just going through all these, and maybe it's I know we've got episodes on it, but maybe it's a good YouTube episode at some point. But at least they're going to say, well, here's the menu you get to choose from. Let's then start to whittle down on this menu that things seem to line up with you, and then from those three or four things, if you have an insurance policy you no longer need, you can donate that instead
Mhm.
of canceling it. You may or may not want to, but you can do it. And just
Yeah, and
quickly to
yeah, go ahead.
top off on this, yeah. Sorry, Adam, you talked enough. I got my time now.
There you go.
And can you? No, you're probably paying me back for the last question. Could
Yeah.
could you touch on donation amounts for tax reduction purposes as a single with a DB pension, survivor's benefit, non-regular income stream? There doesn't seem to be many options to reduce taxes other than donating. And my quick answer to this would be please donate first and foremost because you want to, and then get the benefit because it happens. You're very rarely going to get a one-to-one back or many to one back. If there's very few, if not any, uh, situations I can think of where I give $100 to a charity and I get 120 back. And I don't
Mhm.
think that's the reason for charitable donations to begin with. Um, so I don't know if you got any thoughts for Rusty Fender one there in terms of donation amounts on tax reduction purposes, other than the fact that, as I just mentioned, there are a number, and to sit down with somebody and have those things listed and then start to pick away the ones that you think are going to work best for you.
Well, yeah, and I think it goes back to if you're still working, maybe a year or two left, maybe you want to make a bigger donation, hold it in a GiveWise account, and then give it out to the actual charities. Again, GiveWise isn't the charity; they're just a holder of the money that then give out. They're registered with CRA. That could be a tax strategy, but I think for most people, like how much to donate, where's that sweet spot?
Yeah.
It really like how much aid you want to give, but also how much can you afford in your plan? Like if you're someone that says, "Look, I need this much to spend like the single person and everything when I pass away goes to a charity." Well, okay, let's figure out how much we could give then
Yeah.
throughout your retirement. So, and I will do a full YouTube video on this in the coming months. So I do have it on the docket. Just figuring out, and I want to show our software like how it actually impacts the tax situation for
Yeah.
people.
Yeah. Yeah. I did a plan recently for a client, and it's pretty we know it's pretty substantial, but just to see the numbers change, here's your taxes payable before, here's your taxes payable after. Yeah, it's pretty substantial.
Yeah.
Liverpool 3469, Adam and Brett, two exclamation marks. Thank you so much for valuable information. We thank you. And I also wanted to bring my puzzle piece. May it will fit into some of your future episodes. I am 53. My wife is 52. I have an Alberta LIRA of locked in retirement account of 400,000. I can transfer 50% to RSP, 50% to LIF right now. Question mark. You're almost correct there. I will get pedantic about that in a moment. And can I transfer my maximum lift payments to my RSP month after month? Uh, you want to start off with that, Adam? And don't
Yeah.
make the
So
mistake about the 50% to RSP, 50% to RIF, or I'll catch you on that one as well too. 100% to
yeah,
lift, then it splits out to RSP RIF.
yeah. So the idea here is really, I'm still working. Can I start kind of creating more flexibility for when I actually hit retirement? And to answer his question is, yeah, you can. So one of the benefits of the prairie provinces, and I used to live in Saskatchewan. But Alberta, Manitoba, Saskatchewan, if you have a lift, so you've moved money from a LIRA to a lift, you've unlocked, half of it or more, but you've unlocked some to the RSP. So we're just talking about that lift, the life income fund. You can every year in Alberta, Manitoba, Saskatchewan, move the minimum payment amount from your lift over to an RSP without any tax consequences. So what that does is it frees more money out of the lift and into an RSP or RIF at that point, which don't have the maximum withdrawal limits that a lift does. So again, all we're talking about here is flexibility come retirement. If you live anywhere other than Alberta, Manitoba, Saskatchewan, that is not an option for you. But that is one kind of small little caveat if you live in those three provinces, if you have a lift.
I'm going to correct something there. I think I know what you meant to say, but you said that you can move the minimum from your LIF to your RSP RIF without any tax consequences. It's the differential between the minimum and the maximum. You have to take the minimum. If you have a LIF, you have to take the maximum into tax income. But if you're only taking or if you're taking less than the maximum out, then anything between the minimum and the maximum, you can then move into an RSP RIF.
Correct.
Yeah, without any taxation. So, and that is an income tax act. Shout out to Michelle Connolly and oh my gosh, why am I forgetting your name? Who taught this to me a number of years ago. But that is an income tax act thing. So it is a federally regulated thing, regardless of your provincial jurisdiction. So in case of Liverpool here, yes. So when you start taking money from that 400,000, when you want to start taking money from that 400,000 locked in account, LIRA, then it will transfer into a LIF. $400,000 will go into that LIF. And under Alberta rules, Ontario as well does this, that 50% then can go to your RSP and RIF. And that typically has to happen within about 60 days of the money landing in the LIF. So the clock starts ticking when the money lands in the LIF. And can I transfer my maximum LIF payments to my RSP month after month? Again, you can transfer the difference between your minimum and maximum payments to your RSP. I guess you could transfer the maximum payments to your RSP. You will be paying tax on at least the minimum payments. So,
and this is
regardless of
really
how you do it.
This is really nuanced planning. Like this,
Yeah.
this is the 1%. But yeah, it's good to bring it up because that 1% is always curious on it. But it comes up rarely, but it does come up. Let's talk about RIF to RSP before 71. So hydro golfer, sounds like you golf like Brett, always in the weeds, in the bush, in the water.
Oh, man. Come
Adam,
on.
Brett, good video. One question: if you set up a RIF before age 71, say at 65, and you set up a RIF for 3 years of expenses, do you recommend to your clients holding only safe assets, cash, bonds, etc., and keeping equities in the RRSP? Then during good market conditions, sell equities in the RSP and top up existing RIF. In the end, consolidated RIF, even after age 71, is preferred per person. I mean, again, converting, you can do it. You don't have to move 100% of your RSP to a RIF before age 71. You can do partial. Now, there's 1% of the people watching this or listening to this should do less than all of it. Like there's typically little benefit, but again, this is something you can work through with your financial planner. To answer his question though, like, yeah, you could in good times, yes, sell the equities, top up the cash bucket. And that's what we talk about in that decumulation 101 video series that we're putting together of how do you actually nuance this decumulation strategy. He's added another layer of RSP and RIF, moving that around. But yeah, like in your RIF, if that's 3 years of cash flow, yes, you want it in cash or a cash like, a product where it's not moving with markets and it's very accessible. But again, if you have a 15% rate of return on your RSPs because equities have done good, that's a good year to kind of top back up the cash wedge there.
Yeah. And my answer to this is first and foremost, look at the withdrawals. So what money do we think is going to be coming out of various accounts? TFSA non-registered RSP RIF, it doesn't matter. Because if that money is coming out, again, going back to my RESP education retirement idea, that if that money is coming out of an RSP or TFSA, that's the money that I believe you want to have in something that essentially is guaranteed not to go below zero. short-term GIC, cash, whatever the case may be. So keeping equities in your RRSP and then letting them grow and then top up that, yeah, it could work. But in the year that the market is down, do you have enough money in your RRSP, or sorry, do you have enough money in your existing RRIF to continue to stay on the tax plan that you don't have to sell at a loss? Because skipping 1 year of a tax plan may not be the worst thing in the world. Skipping 2 or 3, or doing it for 3 years and skipping 1, doing it for 4 years and skipping 1, you're just extending the tax plan probably more than you think you are. So I guess in general, yes. And then there, of course, this dovetails into, I don't think we're going to get into the details, the idea of what it's the whole asset location. What investments do you keep in different accounts? Ben Felix did a great research on that. I'm going to say 7-ish years ago, maybe 5. So I won't get into that at this point, but just go in eyes wide open. I'm unfortunately we can't. I don't know if we got into the nitty gritty there, but I think we've had a question from a hydro golfer as well before.
There you go. Yep. And again, that Decumulation 101 video series, like that's really what we're trying to get into the weeds. Obviously, if you're, let's say, own mutual funds at the bank, well, we can't cover every situation with every mutual fund because there's like 15,000 mutual funds out there, right? But it's more the higher level concept of how do we actually draw this down, like this was talked about. So next thing, what we saw this week. So there's an article in money.ca that was titled, "Here are the top 7 habits of quietly wealthy Canadians. How many do you follow?" So I'm going to actually just like read through all 7. And the 7th one is what we want to touch on. But so avoid status symbol. So cardinal rule of stealthy wealthy. I like that term, stealthy wealthy, is to conceal your fortune. So definitely a lot of, it's often the people that aren't wealthy that think that are, again, I drive down my community. The amount of $150,000, $200,000 cars in the driveway it's mind blowing. Maybe they can afford it. They probably can't. Which ties us into number 2, drive modest cars. Typically the wealthiest people I know typically don't drive fancy cars. That's a general rule. Sometimes, if cars are their thing, sure. But I can think growing up as a kid, they always had like the new car, but it was always like the base Honda Civic for $11,000 kind of idea. Of course, the base Honda Civic's a little bit more now. Multiple streams of cash flow. So a lot of the stealthy wealthy won't just have one income stream; they'll have multiple. So that doesn't mean rental properties, but it just it means that you have no matter what the market's doing, you have different, and this really comes down to like the decumulation, like the bucket strategy, right? Like different income streams, different types of investments. It might look and smell similar, but they're different. And if the market goes this way, these ones do better. If it goes this way, these ones do better. That's really the money movement behind that one. Track and direct every dollar. Definitely people that do well know where they're spending money, how they're spending money, how much they're saving. So tracking is obviously very important. They focus on privacy. Again, it's the who was it Floyd Mayweather years ago, like in Vegas with stacks of cash. You don't see that from the stealthy wealthy. So avoid the hyper cycle. So the stealthy wealthy were most likely to make their fortune in relatively overlooked and mundane niches in their economy. So again, we can talk about Bitcoin here. We can talk like that type of structure. Yes, there's people that get wealthy on that. We can say firsthand, we've heard it from clients. We've had some people come in the door. It's like, yeah, I put 250,000 into this, Bitcoin miner, and sure enough, it was a scam, and I lost all my money. And that's happened multiple times. And let me tell you, those stories are really sad to hear. So, Brett, I've covered 6. I'll let you cover 1. That's your allotment.
Sure. Okay. Perfect. That and the golfing comment, I think by episode 10, this is just going to devolve into you and I taking pot shots at each other, and there'll be no financial suggestions at all during the podcast.
I said at the beginning, we're going to do the first 10 and then integrate other team members in here. And it's more for our, make sure we survive at the end of it.
Good for you.
Exactly.
You kind of know my longevity there. Number 7, maximize tax efficiency. And of course, this is what really jumped out at me when I saw this article. I always do what Adam did. I scan the 7 or 10 or 13 or whatever things. Not to say the other ones aren't terrible, but making the most of tax efficient decisions. And I always state this to clients, like the the least amount of tax you can legally pay means there's more money left in your investment accounts, more money left in your pocket, more money going to where you want it to go, not necessarily where the Income Tax Act defaults to. So uh, this is obviously one big thing to look at. Obviously, it's one of the big things that we preach with our plans. Not only having a plan, just to have a plan to see what the future looks like, and are there any what I call icebergs on the horizon that we might have to deal with. But beyond that, can we improve upon this plan? Are there things in the Income Tax Act, for example, or the charitable giving, or whatever the case may be, that we can improve upon the plan? Yeah.
Yeah, yeah. I feel like I need to watch Titanic again now. Tip of the week. We always like to give a tip of the week, and it actually ties into a lot of what we've been talking about today, which is allocating, and we get this question a lot, comment a lot, but allocating your funds based on timeline to ensure withdrawals aren't affected by the markets. And this really comes down to we get a lot of requests, and a lot of people talk about that sequence of return, the Monte Carlo. Like, I want to stress test my plan in case the market drops 30%.
Yeah.
Okay, let's stress test it. Yeah, you're going to be okay. But that doesn't actually mean you're taking action to protect your
Yeah.
assets against that. And so I think there's one thing to talk about and run it through simulators and all that, but why not actually take action on stuff, right? I'm an action person. Like, Brett, you've worked with me for years. Like, I have an idea. It's like, okay, let's action it, see if it works. If it doesn't, we'll throw it out. If it works, let's keep moving forward with it.
One
That's how this podcast started, right? Like, let's
one
just
of
see if it
one of
works.
your
Let's see
best and worst traits, Adam. One of your
yeah,
best and worst.
yeah. You and my wife could have days long conversations on that. But the allocation of assets, it's really again, going back to that Decumulation 101 series, not to harp on that, but that will really guide you through it. And we're going to continue to keep adding more and more videos in that series as well. And again, we'll link that below so you can get access to that. It's absolutely free.
Mhm.
Um, but really allocating funds, like what are the, if your plan shows you need $50,000 out of your RIF for the next, 10 years, but let's focus on the next 3 years. That means 150,000 of your RIF should be fairly protected against the markets, or fully
Mhm.
protected, in that if the markets drop 30%, yeah, the rest of your portfolio is down, but what you need shorter term is absolutely not affected. So it's not changing your retirement. You only have so many go-go years in retirement. It's really important to protect against those. So creating this kind of this bucket strategy on decumulation will do that. So yeah, you cannot control if the market goes down in year one of retirement, but you can control having a plan and then
Yeah.
putting 3 years of cash flow aside. So that's really the tip of the week, is to really focus on that when you enter into retirement.
Yeah, yeah. I love my analogies, and one analogy around this is the difference between airbags in your car and taking a defensive driving course, right? Like, I may feel safe having airbags bags in my car, but if somebody's coming head on to me, I'm not just going to sit there and go, the airbags will take care of it. The Monte Carlo simulation will take care of it. That is
Yeah.
good. It has its purpose. But when we're actually acting on it, it's more of, am I ready regardless of what happens to the market? My clients have heard me say this. When I used to manage investments, I would tell clients, I'm going to invest your money like 2008 happens tomorrow. So whatever money we need in the next 3 years, we're going to invest it in a certain way. Whatever money we need 3 years plus within your comfort zone, we're going to invest it another way. And maybe what we can also link here, as long as it isn't made obsolete by the new videos you're doing, we did a video, I'm going to say it's certainly more than a year ago now, that we still reference to our clients, our financial planning clients, based on this in terms of the cash wedge strategy and how to kind of set that kind of stuff up. So if we have the chance to link that one there too, but at the very
Yep.
least, those new series will be there.
Yeah.
Yeah.
And it is one thing that we really do stress is, we've met many clients. It's like, yeah, I'm retired. I ran Monte Carlo simulations before I retired, and I knew I'd be okay. And it's like, well, how'd those simulations go for you? It's like,
Mhm.
well, it gave me comfort that I was going to be okay, but it definitely changed those years of retirement. And that's
Mhm.
what you need to avoid. And there are ways to avoid it. So, yeah, make sure you understand the decumulation, allocating funds based on the timeline. So, huge tip there for you that every single Canadian, every single retiree needs to implement. This isn't for some people, it's for everybody. So
Yeah.
thank you. That time's up here. So that's episode 5. Thank you again. If you have more questions, comments, whatever, leave it below on whatever platform you're watching or listening on. Thanks for joining us in that one. Brett, thanks again, and we'll see you in the next one.
Yeah, no problem.
Thanks for joining us on this week's episode of Retirement Unpacked. If you found today's conversation helpful, don't forget to subscribe so you don't miss next week's episode. And remember, the ideas we talk about are general in nature. They may not fit your personal situation. Always consult a qualified financial planner before making decisions about your retirement. Take care, and we'll see you next week.